Welcome back, grade 10s. Now let us look at our first concept for the lesson, which is the differences between profit and non-profit companies. So here's a tip. It says the differences or distinctions do not have to link, but they have to be clear. So obviously when you write a distinction between profit companies and non-profit companies, it does not necessarily mean that they have to link, but there has to be a clear distinction of the differences. Let us get to it. Okay, we'll start with the profit companies. These companies are formed with one aim of making a profit, as the term says, profit companies. So basically, when these companies are formed, the main aim is to generate a profit for the company. Whereas on non-profit companies, these companies are formed for charity purposes or to promote social and cultural activities. With non-profit companies, these companies are started not to generate profit, but to make sure that they are for charity purposes or making sure that they promote social or cultural events, maybe some sporting events, maybe trying to reduce some socio-economic issue that is there in the community. Then with profit companies, companies incorporated for financial gain for its shareholders. So when profit companies are started, they are started with the aim of making a profit, and that profit is going to generate financial gain for the shareholders, people who have bought shares in those particular companies that we call shareholders. Then non-profit companies are associations incorporated not for gain. So obviously when you start a non-profit company, it simply means that you are starting a company not to benefit anything, not to gain anything in return, but to benefit the society. Profit companies are responsible for paying taxes based on their profit. So with profit companies, these companies, they pay taxes based on the profits that they are generating or that they have generated. Whereas with non-profit companies, they are not required to pay taxes on net income. So with non-profit companies, the net income, meaning the income that is left after they have spent money on their expenses, on their expenditures. So whatever income that is left, that particular income is not taxed. Let us move on. Now, we are looking at the classification of forms of ownership. So we'll classify them according to profit companies and non-profit companies so that you would understand which of the forms of ownership fall under the profit companies and which forms of ownership fall under the non-profit companies. So under profit companies, we have the private companies are reflected as Proprietary Limited or Pty Ltd. Still under profit companies, we have personal liability companies, which are reflected as incorporated or INC. We also have public companies under profit companies, which are reflected as limited or LTD. We also have state-owned companies, which are reflected as SOC or SOC Ltd. Then under non-profit companies, so we have non-profit companies which are reflected as NPC. So those are non-profit companies. Now let us look at the private company. A private company is a company whose shares may not be offered to the public for sale. So when we talk of a private company, we are referring to a company that does not sell shares to the public. So that is a private company. It is a legal entity and its operations are less strict than those for a public company. So when we say it is a legal entity, meaning it is a registered business, and this registered business, it has less strict regulations that it has to follow when one wants to incorporate it or start it from scratch. Unlike the public company, which has a lot of regulations that it needs, that shareholders or incorporators have to follow if they want to incorporate or start the company from scratch. Then let us look at the characteristics of a private company. It raises capital by issuing shares privately to its shareholders. So the characteristics of a private company is that when they want to raise capital, they issue shares privately to the existing shareholders because they can't sell their shares to the public. The name of a private company must end with the words Proprietary Limited or Pty Ltd. So if you want to start a private company, you need to know that the name of your private company has to end with the name Proprietary Limited or Pty Ltd at the end. So that would be a clear indication that that form of ownership, it's a private company. Profits are shared in the form of dividends in proportion to the number of shares held. So profits are shared in proportion equals to the number of shares that each shareholder is having. So obviously, if we have more shares in a company, it simply means that you are going to get more dividends. So the return for the shareholders in a private company, we call the returns on their investment dividends. So those dividends are determined by the number of shares that each shareholder is having in a company. The more shares you have as a shareholder, then it simply means that the more dividends you are going to get. But the less shares that you have in a private company, then it simply means that the less dividends you are going to get, because the shares are, the profits are shared according to the number of shares that each shareholder is having. Now, let's move on to the advantages of a private company. Shareholders' liability is restricted to the number of shares they own. So basically, in a private company, it simply means that shareholders do not have unlimited liability. They are only liable for the debts. They're only liable for the shares that they are owning in that particular company. So the debts of the company, they do not belong to them as shareholders. Information in a private company is only available to the shareholders. Since it's a private company, they cannot publish information for the public to know what's happening inside that particular business that we call a private company. But information, it's only limited to the shareholders of the company. The company is a separate legal person, so it may purchase assets in its name. So the private company, since it's registered on its own as a legal person, then it simply means that the private company can be able to buy shares in its own name. Not per se it has to be bought, the assets rather have to be bought in the name of an owner or in the name of the shareholders, but they can buy shares with the name, they can buy assets rather with the name of the company, because the company is registered. Now, the disadvantages of a private company is that the private company cannot be listed on the stock exchange, therefore it cannot sell shares to the public. So, since it cannot be listed on the Johannesburg Securities Exchange or on the stock exchange for that matter, it cannot sell shares to the public. You must know, learners, that if a company is not listed on the stock exchange, it simply means that that particular company cannot sell shares to the public. So they cannot raise enough capital as they would want if they were able to do what? To list their company in the stock exchange. But with a private company, since it's not listed, then it simply means that they cannot sell their shares to the public. Some shareholders may not exercise their voting rights, resulting in choosing the wrong person as the director. When it's time to vote for directors, people who are going to manage the company on behalf of the shareholders, you may find some shareholders not voting, not exercising their voting right, and that could result in a wrong person being chosen to do what? To become the director of the company, due to shareholders who did not vote when they were supposed to do what? To vote for the person who was going to manage the company. And let me remind you, learners, that the disadvantages, they are not only limited to the ones that I've just shared with you now. There are many disadvantages that we have. So for this lesson, we only covered these 2 disadvantages. Let us go for a quick ad break and we will be back.